The heart of really what we come to do well is understand our clients.
Understanding what the needs of the family are.
Help them make some decisions.
Preparing the next generation for what's to come.
Being on a first name basis, getting to know their stories.
Working through their questions, their concerns, and figuring out the solution that's best.
They trust us enough to come in and help them solve that.
You really feel at the end of the day when you add value, there's a great sense of accomplishment and reward.
Henry David Thoreau once said, "It's not what you look at that matters, it's what you see." In managing wealth, there's an awful lot to look at. Taxes and trusts, family meetings and bonds, and everything in between. It's why we rely on those who know each of these fields so deeply that they can see where others are merely looking, who can focus on what's best for clients over generations. After all, that's what expertise is.
Mersant International has a dedicated department expressly devoted to the international transportation of horses worldwide. Mersant is privileged to be the official agent for the Breeders' Cup World Championship races and the official United States agent for the Dubai World Cup, as well as the Saudi Cup. Mersant is a licensed custom broker and is qualified to handle all U.S. Customs paperwork on behalf of their clients. The success of Mersant comes from their integrity, honesty, and being transparent with their clients. Okay, well, welcome everyone. My name is Gary Falter, and I'm with the Jockey Club, and just like to welcome everyone to the 2025 Virtual Thoroughbred Owner Conference Series. And we've made some changes this year. If you're online with us now, you know we're no longer using Zoom. It's served us well for a few years, but we've migrated to Microsoft Teams. And if you're watching this live, I think you'll find for the most part that everything looks similar to Zoom. So first time using Microsoft Teams, and I'm sure it'll go fine. So now this is the first panel in our series of 10 panels for this year. And our full schedule, you can find it online at ownerview.com. We'll have the dates and the times and some of the speakers already up there on the website. And the panels, they last between 50 and 55 minutes, and we have Q&A at the end of each panel. And so as this panel progresses, you can use the Q&A feature on your Microsoft Teams screen to send us questions about the topics that we're covering, and we'll try to get to as many as we can at the end of the discussion. So before we get started, I'd like to spend a moment to recognize our sponsors, starting with our presenting sponsors. And you saw the ads for two of them, Bessemer Trust and Stoll Keenan Ogden, and also Keeneland is one of our presenting sponsors this year. And thank you to our presenting sponsors. And our panel sponsor today, you saw their ad, Mersant International does equine transportation. And our Q&A sponsor again this year is West Point Thoroughbreds. And really our sincere thanks to all the sponsors for their continued support of thoroughbred ownership and helping us make this to where we can offer these webinars at no charge to you. So you can see on the screen a very nice list of our sponsors this year, and we surely appreciate each and every one of them. So today, as I mentioned, our panel topic is accounting, legal, and insurance consideration And I'd like to introduce our speakers today. So why don't we bring our speakers on and I'll introduce them. Okay, so we'll start off, introduce Chapman Hopkins from Stoll Keenon. Hi, Chapman, welcome. So Chapman is an attorney and he's also a member of Stoll Keenon Ogden's Lexington office. And he practices in the firm's equine department, and he also serves as a chair of the law firm's equine litigation group. So welcome, Chapman.
Thanks.
Okay, and next is Mike Levy. Mike, raise your hand. I know, yeah, we've got your name as Ian Jones. You might be using somebody else's computer. That's all right. Welcome, Mike. So Mike's a third generation horseman, and he's the president of Muirfield Equine Insurance. And Mike founded Muirfield Insurance in 1991. What, were you a teenager then, Mike? I think you're muted, Mike. Let's unmute yourself. There you go.
It wasn't far past that, but a few years after that.
Very good. Okay, and Joe Doherty. Welcome, Joe. Joe, you might be muted also. There you are. So Joe has got more than 13 years of experience in public accounting, and Joe leads the Dean Dorton Equine tax practice. So good to have you with us, Joe.
Yeah, glad to be here.
Okay, so we're going to start off talking about some of the changes that you may need to know as an owner about equine accounting. We're going to start with Joe, then we'll bring in Chapman and Mike here in just a moment. So Joe, every year there seems to be new tax changes, and many of those changes can affect our industry. So talk about what's changed in the past year and how it might impact thoroughbred owners.
Yeah, so from a tax legislation perspective, not a lot really changed in 2024. That's not uncommon in an election year. One thing that did change is the bonus depreciation is down now to 60%. And absent some tax legislation in 25, that'll continue to go down until it phases out in 2026. But however, as quiet as 2024 was, we do not anticipate 2025 to be quiet at all. Many of the provisions of the Tax Cuts and Jobs Act of 2017, which, that was the most significant tax overhaul since 1986. Most of those provisions are set to expire at the end of 25. The president's prioritized bringing back 100% bonus depreciation for 25. He's mentioned it in several of his speeches, but nothing is really a certainty at this point. I think, what is a certainty is that there will be tax legislation in 25. We're just not sure what that will be just yet. Our legislative contacts tell us that the goal is to have a bill on the president's desk by Memorial Day, but we'll see how that goes. Okay. But one other thing I'll mention, and it's not necessarily a tax law change, is the IRS disaster relief. For those affected by the California wildfires and the flooding in Kentucky and North Carolina. There are other disaster declarations. There's a ton of them, actually. These are just the two that I'm most familiar with. But basically how they work is if you're covered and if you reside in one of these covered disaster areas, the IRS will postpone filing and payment deadlines for many tax returns. So you can actually visit the IRS website or the FEMA website to determine if you're in one of these areas and what the specific relief would be. I know for California, that was limited to Los Angeles County, but for Kentucky, for example, that ended up being the entire state was declared a disaster area. So, yeah, that's it.
So do you find that in the middle of the year or throughout the year, some tax laws change that owners should be aware of, or most of those effective the first of the next year, retroactive? I mean, how does that work?
Yeah, so that's really one thing that's going to be up for debate. The last few times that bonus depreciation has been legislated, it was retroactive, but there's no guarantee that it would be retroactive. I think in the president's joint address last week, I think he specifically referenced making it retroactive to 1/1/21 or 1/1/25, but we just don't know at this point. It could be as of the day that it's enacted. The good news here is it seems like it's going to happen early enough in the year that, if it isn't retroactive, you've got several months to kind of plan for it.
Okay. Okay. And I would guess throughout the year, owners should just check with their accountant
For
and
sure.
their attorneys to see if anything has changed, unless they're keeping their ear to the wall.
Right.
Okay. So what are some of the tax considerations if an owner is buying a horse or even buying a farm? How do you structure that? And how does depreciation work? Any tax incentives or tax limitations? So, go as deep as you want with this.
Yeah, well, I could take the entire webinar and just answer this question. So I'm going to try to be very high level, very brief. But just from a structure standpoint, the two questions you need to ask is, what kind of property are we dealing with? And do I want to own it myself, or do I want to own it with someone else? Certainly if you want to have multiple owners, then there's the co-ownership model, which really you see that with horse ownership. But there's partnerships, there's S corporations, there's even C corporations. Now, I think we'll get into a little later kind of why you would and wouldn't want to do maybe the S corp or C corp, especially if you've got an entity that has a lot of assets or appreciated property. But in general, like, these are kind of the structures that you would work with. And then, obviously the limited liability company, I think we'll touch on that later too. But it's kind of a hybrid. It can take on whatever form that, you need it to be. It can be a single member owned LLC. It can be an LLC taxed as a partnership. It can be an LLC taxed as an S corp. So the limited liability company, you see those. I would say most entities that I see these days are limited liability companies. So just from a structure perspective, so, accounting for the operations, the accounting method is going to be really important here. I would say that most horse owners qualify to use the cash basis method. If your gross receipts are less than $30 million, you can generally use the cash basis method. That's usually the preferred accounting method because it accelerates deductions for income tax purposes. So in other words, it's a deduction when you pay for it, it's income when you receive it. I would say, just from the cash basis point of view, you don't want to get into a situation where you're just paying expenses just to get a tax deduction. The IRS rules actually say there needs to be a non-tax reason for prepaying expenses. But generally, as long as you're not abusing it, the cash method is usually the optimal accounting method.
Okay.
Some depreciation considerations. So, what all depreciation is in a nutshell is you're just recovering the cost of your assets over a period of time. Different assets have different lives. So, horses, for example, they're either going to be 3-year property or 7-year property. If you're dealing with real estate, so like a barn, for example, that's going to be 20-year property. Your leasehold improvements, 15 years. So what that means is that's how long it's going to take you to recover your cost in that asset. Now, the bonus depreciation speeds that up significantly. It has been 100% up until 2 years ago, and now it's down to 60. But that's the accelerated aspect of that is what makes it so attractive. With bonus depreciation, most assets that have a 20-year life or less qualify for bonus. Now, I'll caveat that with saying there's some exceptions to that. So you could have an asset that falls into one of those lives and doesn't qualify for bonus depreciation, but generally assets with a 20-year life or less would qualify for bonus. Now, what I'll say is if you're purchasing real estate, a lot of times we recommend either if you can get an agreed upon asset allocation between the buyer and the seller, that's great. If you can't, we'd recommend getting a detailed appraisal that kind of assigns value to the land improvements, the fencing, things like that. In the absence of those two things, you can even get a cost segregation study, which kind of does the same thing. And the whole point of that is that you want to allocate as much of the purchase price of your real estate into those lower lived assets that qualify for bonus depreciation. So, if you're spending $5 million on a farm, the more of that you can allocate to a 20-year life or less, then that's, obviously you're going to speed up your recovery period a lot faster that way.
Okay.
And then another depreciation incentive would be Section 179. It's similar to bonus depreciation in that it allows you to expense something up front. 179 is actually 100%. There are some limitations to it that I won't get into, but the big one here for horse owners is that it's limited to net taxable income. So you don't see it quite as often. And you have to be an active trader business to qualify for it. So there's a few hoops that you have to jump through with 179 that you don't have to deal with bonus depreciation. So you don't see it, again, you don't see it as often, but it's there if you qualify for it.
Okay.
And then just, generally speaking on who's making those decisions, if you're owning these assets in an entity, then those decisions are getting made at the entity level. And maybe you've got some influence over those decisions, maybe you don't, but the decisions are made at the entity level and it's passed through to you on your K-1. If it's a co-ownership, scenario, that, each individual owner is making their own decision on the depreciation. So you kind of get a little bit more control there.
Okay.
And then, go ahead.
Yeah, I was going to say next year, I think we might even bring in a topic of just all the ins and outs of purchasing a horse farm. I think we could spend an entire panel covering the legal, the accounting, the insurance aspect of that. Just, bring in a real estate expert and really cover that topic. We have all the topics covered this year, but I think that's one that we might bring on board next year.
Yeah, very beneficial.
Mm-hmm. Okay. So there's rules the IRS has on operating your horse ownership as a business and as a hobby. Can you just kind of hit the highlights on that? We've talked about it in the past, but I think it's always worth covering this again.
Yeah, so my colleague Jen Shaw, she spends a lot of time in this area. So hobby loss defense cases, IRS exams. In a nutshell, from a tax perspective, if your activity is deemed a hobby, you got to recognize all of the income and you get no deductions. So it's a double whammy. So if you're operating or trying to operate like a business, it's important you understand the hobby rules and the kind of things you need to be doing to be treated as a business. So what does the IRS look for? Well, they list 9 factors that kind of determine whether an activity is conducted with the intent to make a profit. Not going to go over all 9 of those factors, but what we see is the most important is factor 1, and that's running the operation in a business-like manner. So that usually means you're maintaining good books and records. If possible, you're tracking on a per horse basis. You're kind of doing evaluations over time to kind of see what works and what doesn't. And you're addressing things that need to change to kind of achieve that profit potential. So, if you're like me, you can't remember what you had for lunch last Wednesday. So, what we typically recommend here is on an annual basis, that you do at least maybe a short summary of what happened during the year. So kind of what went well, what changed, what kind of metrics are you using to evaluate, what were some key operating activities that happened during the year, things like that. That way, if 1 or 2 years down the road, the IRS comes in and questions this, it's a lot easier to start when you have something like this already prepared than just trying to remember something that happened 2 years ago. And then last thing is there's something called a 2 out of 7 presumption. And what that basically means is if you can generate a profit in 2 out of 7 years, it's presumed that you operated with an intent to make a profit for that period. Now, that doesn't mean that if you do that you're not a hobby. It just shifts the burden of proof, right? So if you meet the presumption, then the IRS has to prove that the IRS has to prove that you are a hobby. If you don't meet the presumption, that doesn't mean you're a hobby. That just means that the burden of proof is shifted to you, and you have to prove to the IRS that you're not a hobby.
So a horse operation that is considered a hobby, can they deduct expenses against income? at all?
No, so the way it used to work before the Tax Cuts and Jobs Act is all of your hobby expenses were considered miscellaneous itemized deductions. So when the Tax Cuts and Jobs Act in 17 was put into place, they eliminated the miscellaneous itemized deductions. So effectively, you still have to pick up the income, but there's nowhere to recognize the deductions anymore.
Okay, all right.
So
Good to
that's
know.
what I mean by that. Yeah.
Yeah, okay. Okay, well, let's pull Chapman in on the conversation, and Mike, we're going to get you in here real soon. So Chapman, laws, legal considerations, what do you think all horse owners, especially new owners, should be aware of as it relates to just the whole legalities of being a horse owner?
Sure. So like Joe said, that it's a topic I could speak for the duration of this panel and probably several more, but I'll try and distill a few things down.
Sure.
The starting point for me, especially with any new clients, new owners, is getting into a mindset that the equine business really needs to be treated just like any other business. I think we all too often see new owners come into the sport or to the industry with the mindset that they're doing it for fun and they don't need to take things as seriously or in a sophisticated manner like they do outside of the sport. And I think that's the number one pitfall that we see. And that applies to, low net worth, unsophisticated owners as equally as it does to high net worth, ultra sophisticated businessmen and women who get into the game. There's something about it that they get into it, and all of those guidelines and best practices that they would utilize in their business outside of the equine industry are kind of put to the wayside. So from a starting point, I would encourage new owners to come into it with a mindset that while it should be fun and it should be entertaining, it is a business, like Joe said, and you should do everything you can to treat it accordingly. So if I could identify three things that I would keep at the forefront of my mind, they'd probably be contractual considerations, regulatory components, and then just general liability principles. So on the contract side, like we all know, it's a business that was rooted in and driven by handshake negotiations, a spirit of trust and cooperation. And I think all of those things are important. All of those things, I think, by and large, still are pervasive within the industry. But I would encourage new owners not to be scared by contracts and not to be reluctant to look for contracts, enter into contracts, and have a mindset of papering up relationships. The benefit to getting into a contract, whether it's a bill of sale or it's a co-ownership agreement or it's a boarding agreement, is one, it memorializes and reduces uncertainty between the parties. But the benefit that I've seen on the front end is it forces people to think about things that they wouldn't otherwise think about. I think a lot of times people get excited and they want to get into a deal or they want to start boarding a horse or get into a co-ownership, and they're excited about doing it. And they think about some of the very surface level issues that they need to iron out, and they get a handshake over that. But because they haven't gone through the process of papering it up or talking to their accountant or their attorney or insurance advisor about other ancillary issues, a lot of things get missed. And eventually over time, issues will pop up that they never even thought about. And that's a primary source for conflict down the line. So a little bit of time and money and effort and candidly uncomfortable conversations on the front end can save people a whole lot of angst and conflict down the line. The second piece, regulatory components. I think new owners have to keep in mind that it is a regulated sport, both at the state level and the federal level. On the federal level now, we have HISA, and that largely oversees medication and safety protocols and requirements. That's done at the federal level, and owners now are subject to a whole host of federal requirements in that regard. And they've got to register with HISA. They have to make sure they conduct their operations consistent with HISA. And even though that's a relatively new issue, it's something that people now have to think about. On the state level, there are still state regulatory requirements for things like licensing, ownership, trainer operations, and each state is similar, but there are differences between each state. And so on the front end of ownership, especially if you're going to be racing, You need to be cognizant of the fact that what you do is going to be subject to state regulatory requirements. You're going to have to get licensed. You're going to have to comply with those various administrative regulations that come into play. And then finally, just general liability principles, whether that's premises liability, whether it's liability associated with contractual issues. There are a number of different areas where you have liability exposure. One thing in particular I'd encourage people to be aware of from a personal injury and premises liability standpoint are equine activity liability acts. So most states where there are thoroughbred racing regulations, they have enacted statutory equine activity liability acts, which provide certain protections for people engaged in thoroughbred racing and equine farming operations. Those are very nice protections to have, but in order to avail yourself of those protections, you have to comply with certain statutory requirements, like posting warning signs, like providing notice, things like that. And so if you don't know about those, you can't avail yourself of the protections that are there. So if you're going to own a farm, or you're going to have a horse, or you're going to be engaged in equine operations, I think you at least need to have a rudimentary understanding of those kinds of protections that are out there.
So what are some of the pitfalls that you've seen through your practice that owners, especially new owners, fall into that, if they knew about it, they could avoid?
Yeah. The first one's very easy, and it ties into the first thing I mentioned, which is putting written agreements in place. That's bills of sale. I see it a lot with co-ownership agreements. 3 or 4 people go out and purchase a horse, and they assume they're going to get along and be able to make decisions about where to enter the horse, what trainer to put it with, when to retire the horse, things like that. In the absence of a written co-ownership agreement, I tell people all the time, the lay of the land is that you're co-owners of a chattel and you have your individual interest, and you can't really force each other to do anything that the other person doesn't want to do. And the only way to resolve that is unfortunately to go to court and ask for a partition and deal with it on the back end. So I would encourage people to not fall into the pitfall of avoiding contracts and avoiding those front-end discussions simply because they may slow things down a little bit, or they may be somewhat uncomfortable.
Okay.
Another area that causes some pitfalls are liens. Horses are goods under the Uniform Commercial Code, and as a result of that, there are any number of different liens that can come into play with horses in terms of service providers placing liens on the horse, in terms of what you have to do with those liens if you're going to sell the horse, if you're going to transfer title to the horse. So I think it's important for people to have a basic understanding of what those liens are, whether they're stallion keepers, veterinary, adjusters liens, basic security interests that other lenders can take in your horses and your equine assets. And that's both understanding it from the standpoint if you own a horse and you don't pay for certain services, or you have a lien against it as a result of taking a loan that could be applied to it, you need to know that. But if you're going to purchase a horse or you're going to go to an auction, you need to understand what the risks are with liens that could be on the horse. Something as simple as if you're going to buy a horse, conducting a basic UCC search to see if there are liens out there. Because there's situations where if there is a lien against a horse and you didn't do your due diligence to search whether a lien's in place, the creditor or the person who has the lien may be able to come after the horse or come after your interest, or at least make things difficult on the back end. So liens are a really important thing to know in an area for pitfall that I see time and again.
So is it safe to assume, sorry, let me just throw this in real quick.
Yeah, go ahead.
If you buy a horse at public auction, Keeneland, Fazek, Tipton, OBS, you name it, that there are no liens attached to that horse?
Generally speaking, that is a safe place to go. Most states where those auctions are conducted have rules associated with horses purchased at public auction. And so that if you are a buyer, in order to facilitate that commerce, facilitate that trade, there's a principle that if the horse goes through auction, you take it free and clear of those liens. That reality, though, creates a lot of work on the front end that people who do have liens on horses who are going into a sale have to be aware of those liens. They have to monitor their collateral so that if I have a lien on a horse and it's going through auction, I have to understand that I have to pursue that, file a claim to proceeds with the auction company so that when the proceeds from that sale come in, They don't just go to the person, the original owner. I have the chance to go after those proceeds.
Okay. Okay. And you have one other point you're going to make?
Other area of pitfall I'd really point out, especially for anybody getting involved in racing syndicates, ownership syndicates, breeding syndicates, pin hooking, things like that, are just basic securities issues. Securities laws, the Securities and Exchange.
Nope. Looks like Chapman might have froze up. Okay. Mike, can you hear me?
I can.
Joe, can you still hear me?
Yeah.
Okay. Well, Chapman, I don't know what happened with your screen, but you're kind of frozen on us. So I'm just going to move on. And if you come back on, great, because I want to I got some more questions for you. So let's move on to Mike and talk about some insurance issues. Mike, so there are many types of equine insurance available to owners. So why don't you spend a little bit of time talking about what are some of those insurance options?
The most common form of insurance that we sell is all risk mortality. So you buy a horse, you call us up, you want to buy mortality insurance in case something terrible happens to your property. I'd like the people listening to think about it as term life for horses. 95% of the policies are annual, and the premium rate is based on the age and the use of the horse. That's the most common thing. The other one that I feel is very important, and we were going to hit on it with Chapman, and we can hit on it some more when he comes back, is racehorse owners liability.
Yes, please talk about that. Yeah, racehorse owner liability policies.
It's
welcome back, Chapman. Okay.
Sorry, I don't know what happened there.
That's all right. We'll jump back to you, but Mike's talking about insurance and wants to talk about the racehorse owner liability. So glad you're back.
So everybody thinks they have a homeowner policy, or they have a big umbrella, or I already have liability insurance that'll cover something if it happens with my horse. It doesn't. And there is a specific class of insurance called racehorse owners liability that we urge every customer client to consider. It's very inexpensive. Your standard policies cover up to 3 horses with $1 million limit of liability annually for somewhere between $300 and $500, depending on the value of the horse. And the biggest thing that this coverage does is it pays for your defense if you are sued. And in the litigious world that we live in, your horse gets loose, runs into somebody, heck, it can even scare somebody or damage property. Somebody's going to come after you. This will pay for your legal expenses. And so we strongly encourage that. Other than those two, we do farms, we do autos, we do prospective foals on mares, we do stallion insurance. It'd be a little bit too cumbersome to cover them all, but those two for any owner are the most important ones.
So you're saying a person's personal umbrella policy wouldn't cover the things you just mentioned?
Personal umbrella policies do not cover equine related claims.
Okay. All right. Anything to that, Chapman, or is that pretty much covered?
Yeah, I think that's spot on, and I think that might hit the nail on the head. That's a very common misconception, that people think they have an umbrella policy and they're good, and that's almost certainly not the case.
Do you think most racehorse owners have policies like that, Mike, or is it something that most owners don't bother with?
Well, as I said, we encourage it strongly. When somebody calls and says, you know, I just bought this horse for $100,000. What do I need to do? Here's your rate for mortality. Do you already have racehorse owners liability, or would you like to discuss it? And the uptake on it is very good. Large investment, not walking around money, an extra $300 to $500 to cover your butt for a year is well worth the expense.
Okay. So as we're speaking here, the OBS sales going on down in Ocala. So, at what point when a horse goes through the ring, does the new owner take owner responsibility for that horse? Is it as soon as it leaves the ring, when the hammer goes down? So exactly when does that responsibility start for the new owner?
The responsibility for the new owners is when they sign the acknowledgement of purchase agreement with the sales company. So the hammer drops, somebody brings you a ticket, you sign it, it's your horse. If it walks back to the barn and something terrible happens, that's on you. If it injures somebody on the way back to the barn, that's on you as well. We offer something called follow the hammer insurance, where if you're going to go to a sale and you're going to be actively bidding, if you let us know beforehand and you're the successful bidder when the hammer drops, you are covered. No ifs, ands, or buts. And so if something happens after you sign your acknowledgement of purchase, you are covered for the value of the horse, as well as racehorse owner's liability if you choose to take it.
So Chapman, what happens if somebody is bidding on the wrong horse and then the hammer goes down and they refuse to sign the ticket? Does the horse go back into the ring, or does it get to be a legal issue at that point?
Does get to be a legal issue. I think auction companies would handle each of those situations as they come. It's kind of a fact-intensive inquiry. Typically, auction companies will have an attorney on premises to deal with those issues as they come up. You hope cooler heads prevail and that people can be reasonable about what's transpired, and it really is a fact-intensive inquiry about whether there's justification for allowing them not to proceed with being compelled to purchase the horse, whether you can put it back through the ring. It's a little bit different in every scenario, but I'd be lying if I said it doesn't happen at every auction.
Okay. Well, we had a panel a couple of years ago talking about that whole auction process, and one of the bid spotters said he had a client, as long as he had his pen in his pocket, he was bidding on the horse. Well, the guy had his pen in the pocket, so he kept bidding it up, and then he took a phone call and he forgot to pull the pen out of his pocket and ended up spending a lot more for the horse than he had planned to. So, but it goes with the territory, I guess.
It does. You had a lot of dynamics at play there, whether it's the owner, whether it's an agent, what was the extent of their authority, all the above.
So Mike, there's a lot of horses out there that owners claim. Talk about how one would go about having a horse insured that they are planning to claim, or, as they claim a horse. How does that work?
So this claiming insurance has changed dramatically with HISA coming into play. And Shannon, can you put up the void claim rule, please? So it used to be that if you dropped a claim for a horse when that and you won the shake, or if you were the only person claiming, when the gates opened, that was your horse. Whether it came back injured, whether it didn't finish the race, you still had the burden of paying for that horse and then subsequently caring for it thereafter. HISA has come in, and they now have the void claim rule. So this applies to every track that operates under the HISA rules, which is pretty much everybody other than West Virginia, Louisiana, maybe, and perhaps Texas. So as everybody can see, if you drop a claim on a horse and it doesn't finish the race, the claim is void. If the horse is placed on the vet's list, is unsound, has bled through the nose, the claim is void. So there are many more protections for people who want to claim horses than there used to be, where they would have to call me, say, I'm going to claim this horse. Okay, you're covered when the gates open if you're the winner of the shake. This is a very, very good rule. It encourages participation, and it alleviates ambiguities or uncertainties, especially for people that are new in the game.
Okay, good to know. So there are a few states though that doesn't apply to you. You mentioned.
That is correct. I know West Virginia for certain, and I believe Louisiana, but and I'm pretty sure about Texas. But
so many years ago, my brother and I claimed a horse and got her back to the barn, and she was as lame as can be. With the rules of today, that would have avoided the claim.
Yes.
Okay.
100%.
Good to know. Good to know. Okay. Well, Chapman, I'm glad you're back. I want to circle back with a couple of questions for you and Joe. So you guys mentioned forming a partnership, LLCs, corporation. Can you guys talk about the pros and cons of each so that those in the audience that are thinking about any of those, you can give them a little bit of background?
Sure.
You want to start from a tax perspective? I can talk about from a structuring perspective and we can go back and forth.
Yeah. So, partnerships are, they're very common in the equine industry. They're, formal. They usually have a partnership agreement. They do have separate income tax filings, but ultimately the owners get taxed on their personal returns. So they get K-1s. Different kinds of partnerships. Most of those different kinds have to do with liability protections, kind of outside of, a tax reason for those. S corporations, those are flow through entities as well. So they're similar to partnerships. I kind of mentioned it earlier. You don't really see those with operations that have a lot of appreciated property because it's really hard to get those assets out without paying income tax. So with S corporations, what you typically see are like your service providers, so trainers, bloodstock agents, like not operations with not a lot of capital intensive assets. And it limits your exposure to self-employment tax. Doesn't eliminate your exposure. It just limits it because you pay yourself a salary. And then, from the corporation perspective, C corporations, you don't see this very often at all. I mean, especially with U.S. owners, unless it's a very large ownership group. So maybe kind of the micro shares, you'll see, C corporations like that. But those are, so the C corporation's an entity level tax. So it's taxed at the entity level. If you ever try to take cash out of the corporation and there's earnings and profits, you could be dealing with double taxation issues. And of course, if you've got appreciated property, again, it's really hard to get it out of there without paying income tax on it. So you see those with large ownership groups. You'll usually see them with non-U.S. owners that have an activity in the U.S. that they kind of want to limit their income tax exposure to the U.S. But yeah, I mean, that's generally, partnership, S corporation, C corporation. Chapman, if you want to chime in.
Yeah, that's largely consistent with what we see. When I'm looking at it from a legal side, I'm looking at it in with a few key things in mind. One, liability protection. What do they need in terms of being insulated from liability? If you're operating under just a informal partnership or a co-ownership, that arrangement in and of itself isn't going to provide you any insulation. Conversely, if you're in an LLC, you're in a corporation, somebody would arguably have to pierce the corporate veil or go through the corporation in order to go after your have involved in the operation. And so that's the starting point, is what do you need from a liability standpoint? Beyond the liability, it's really about formality and flexibility. If you're going outside the entity side and you're doing an informal partnership or a co-ownership, I would still encourage owners to paper that up and make sure you're still drafting things that outline all of your various needs, and you have infinite flexibility in the form of a co-ownership because there are no statutes that provide or maintain a baseline of what has to be identified in that co-ownership agreement. With a corporation, on the complete other end of the spectrum, you're going to have very formalized structure, legal requirements, things that have to be in there, whether you have to have the bylaws that you have to have, the corporate officers that you have to have, how you handle shares, ownership allocations, all of those sorts of things. And then the LLC typically falls somewhere in the middle. I think, as Joe said earlier, the vast majority of entities that we see formed are LLCs because of the liability protection combined with the flexibility. Each state has its own LLC Act that will outline how a limited liability company is to be operated and what everybody's rights and responsibilities are in the absence of a written agreement. That means that you have the flexibility to draft your own operating agreement for your LLC that can take you out of some of those baseline statutory provisions, and it gives owners more flexibility to operate.
Okay. Another question I have, so both your firms, Dean Norton, Stoll Keenan, do your firms assist owners in developing business plans and advise them from that perspective? So if an owner wanted to develop a pretty comprehensive business plan, who could they turn to?
I mean, the short answer for us is yeah, we can certainly assist with that. You know, a lot of times it's really easy to sit down and project out, you know, what the expenses are going to be. It's a lot harder to try to figure out where the income streams are going to come from. So, you know, I think Chapman mentioned this earlier, you know, typically when we do this, if they're entrepreneurs and they've got other business ventures, we kind of look at, well, what did you do in those business ventures that made you successful, and try to apply those same principles to your horse ownership activity. But yeah, I mean, certainly, again, yeah, we could certainly assist with that.
Yeah, we see business plans, and we encourage people to put together business plans, especially if you're doing anything of any kind of scale or size. One, because it's just a good business practice. Like I said before, treating it as though you would any other business. But the second piece really ties into the legal considerations. And when I got cut off, I was talking about securities concerns. I think it's crucial that if you're going to do something like a racing syndicate or Pinhook, and you're going to be bringing on investors, you're going to potentially implicate securities laws and securities requirements. And so there are going to be things like restrictions on whether you can solicit, how you can advertise, whether you can go after unaccredited investors, whether you can put up advertisements on your websites. All of those things come into play. And it's important to talk to clients on the front end. It sounds good to say, yeah, I'm going to start a racing syndicate, and I'm going to throw up a website, and I'm going to ask people to come on, and I'll let them buy $1,000 shares. Well, if you're not doing it the right way, you've arguably committed a securities violation because you're engaging in general solicitation of unaccredited investors. Hopefully you never get in trouble with the SEC for that, but I like to see the business plan, because if I can, it helps me identify those kinds of red flags. If they had budgeted hiring a third-party consultant to bring on investors, and they intend to pay them a commission tied to how much money they bring in, well, then that looks like a broker dealer, and it may have implicated securities issues once again. So I think developing a business plan is good from a best practices, just general business standpoint, and it can be really informative from a legal standpoint to make sure you're structuring things the right way.
Okay. Well, you make a good point, because we launched OwnerView in 2012, and we have an entire list of racing syndicates on OwnerView. And as part of that model, I wanted to show on their profile what their buy-in model was. And we were advised by our friends at Stoll Keenan that you got to be careful, because you're crossing into SEC territory. So, you know, we should take care of that. So very good point. And, you know, just advice to our audience, you know, if you are, you know, bringing in or thinking about a syndicate, just make sure you're aware of what those rules and those laws are. So that kind of segues good into my next question for all of you, to talk about racing syndicates and these racing clubs. You know, they're popular. A lot of people are involved in them. So what are some of the legal, accounting, and insurance issues that members of these syndicates and racing clubs should be aware of? So Mike, why don't you start off on the insurance side? I'm a member of my racehorse, we'll say, and what should I be thinking about as it relates to insurance?
So we do a lot of work with a bunch of different syndicates, and segue into what Joe and Chapman were just talking about. Normally, every individual horse is its own LLC. That's the most popular way for a variety of reasons. So that LLC the syndicate manager will buy mortality insurance and own racehorse owner's liability for the members of that particular LLC. And it doesn't matter if one person is in 5 different horses with the same syndicate manager, each LLC will have its own full protection for mortality and liability. And that, you guys chime in, that seems to be the safest way. We do some work with some other syndicates that do an opt-in, opt-out model for their partners on whether they want mortality insurance or whether they want racehorse owner liability. It hasn't become a problem in 35 years, but if the syndicate manager is not proficient in explaining the risks associated with opting out, then I think there could be a problem down the road. But for the most part, if you're buying 2% of something with Eclipse or West Point or whoever it may be, you're going to be covered.
Okay. So if that syndicate does cover the horse, can I, as a partial owner, insure over and above that?
No, that's usually left up to the syndicate manager.
Okay.
There are, when we get into situations where we have a multi-million-dollar animal, some people don't want to pay the share of the premium once it goes sky high. So that we do have a few opt-in, opt-out situations when it gets up in value significantly. But for the most part, everybody goes with the flow. They're writing a check. They have expenses built into that in the syndication value. So it kind of works that way. And the horse will be insured for mortality for the syndication value, which is not necessarily what the horse costs, because they add in some fees and they add in a time period of training. So they're not going back and chasing individual 2% training bills.
Okay.
Yeah. I touched, I think, a lot already on the securities issues, and that's the paramount concern with any racing club, racing partnership. You have to make sure on the front end that what you have in mind in terms of investors, solicitation, advertisement, and control square with all of that. And that sounds daunting. It's not as daunting as it seems, as long as you take a little bit of effort on the front end to deal with it. But beyond that, 2 main issues I see that people tend to not think about until well down the line. The first is licensing issues. Licensing can get tricky with racing syndicates and racing partnerships. Each state is a little bit different. Some states like California will allow an entity to designate a manager to hold the license on behalf of the ownership group. Other states like New York want to say that everybody who has more than a 3% ultimate beneficial ownership interest in a horse is required to be licensed. And then there's everything in between. But you have to be aware of where you're going to race and what you want the program to look like and whether people can be licensed on the front end, so you can determine that what you have in mind for your structure squares with that. Because a lot of times people will, they'll have 10 different owners and they say, this is my second racing partnership. I've got 10 owners in this one. I'm just going to hold the license for everybody and it's going to be my name on the program. Well, that may not square with racing regulations in New Jersey if you want to run there. We ran into an issue in Kentucky where they've amended the regulation since then, but it's a good example that there was a licensing regulation on the books that said there can be no more than 5 licensed owners per horse. Well, there was a co-ownership group who had 7 owners. All of them wanted to be licensed. All of them wanted their name on the program, and that caused issues. So you've got to be very aware of what licensing and stable name requirements are before you set about setting up your structure. And then the second piece is just practical concerns. A lot of people get fixated on bringing the investors in. We're going to have a horse we're going to run, and they don't think through the practical issues like licensing, like I said, paddock access, allocation of silks, who's going to talk to the media at the end of the day, who can speak on behalf of the partnership, who's going to get tickets, and how are tickets going to be allocated. Those sound like very minor things, but they can become very big things, especially when you have a successful horse. So I would encourage anybody that's going to be doing a racing syndicate or a racing club to think through how they're going to deal with all those practical issues, and then be transparent about it in whatever offering documentation or operating agreement you have, so that when investors come on, they don't end up in a place where their expectations are different than reality.
Okay. Just want to remind the audience, we've got a few more questions, and then we're going to jump to the Q&A from the audience. So if you have a question for any of our speakers, please use the Q&A button that you'll find on your Microsoft Teams screen. So Joe, a person that's a part of a racing syndicate, a racing club, they own fractional micro shares, can they still qualify to operate their ownership as a business, or are those almost all fall into the hobby?
Yeah, so if it's a racing partnership, those are pretty turnkey. So usually you're putting in the money. You don't really participate in any of the activity. It's kind of managed. You get a K1, maybe it's got income on it, maybe it's got a loss. Most of the time you're going to be passive in those, and that just means that if you're passive and you don't have some other source of passive income to use those losses, then it might be several years down the road before the activity would have to dissolve before you would get to utilize those losses. So that's, kind of one thing we see with the racing partnerships. The micro shares, especially the ones that are held in like My Racehorse, those are C Corp entities. You buy your micro share and, you're not going to get anything until, they pay out a dividend. So if you put in $1,000, you don't get $1,000 deduction for anything. You're just putting it in the corporation. And if it's successful, maybe you get a dividend, maybe you don't. But the corporation, if you don't ever get anything back, the corporation would have to dissolve effectively before you would get to deduct the funds that you put into it. So a lot of situations where you get losses trapped for a period of time that kind of blindsides the owners.
Okay. So the question for all three of you. So what would be your opinion? What should an owner budget annually to have a horse in training? I'm asked this question all the time. What's it cost to have a horse in training? I know it varies. Horse could be laid up for a long time, but just an average, what are your thoughts from your experience with what it's going to cost to have a horse at the races for a year?
Yeah, so I'll start. So we do a lot of these racing partnerships. I would say on average, you're probably looking at $50,000-$60,000 a year. And of course, that could be less, that could be more, depends on what part of the country you're racing in, depends on what kind of what trainer you're using. But I would say a good average is probably 50 to 60.
Okay.
Yeah, I agree with that. It's not just the training bill. It's the vanning bills. It's the vet bills. It's the farrier bills. It's the good old insurance bill. It's, the licensing fees, et cetera, et cetera, et cetera. But I would definitely agree that somewhere between 50 and 60.
Yeah.
Okay. That's a number I've heard often, so I think that's a fair representation. So let me just ask one more question, then we'll go to the Q&A from audience. So from new ownership, what do you consider the most important in becoming and staying a successful thoroughbred owner? So just go around the horn. What do you think is one or two things that are so important for a new owner to do, or to have part of their business plan to be successful? And I don't mean just winning races, but to enjoy the experience and to be an owner for many, many years. One or two things.
Educate themselves extremely well before writing a check, and make sure they're aligned with trustworthy people that have good experience factors.
Okay, so aligned with good people, very good. Yeah, and come to these webinars, you'll learn a lot.
Yeah, I'd say don't be afraid to have uncomfortable conversations, whether
Very
that means fully vetting your trainer, fully vetting your agent, fully vetting your counsel, whether it's insurance, accounting, tax, legal, any of the above. And then tying back to what I said before, negotiating contracts, a little bit of uncomfortable conversation on the front end can go a long way towards avoiding conflict on the back end.
Okay, excellent. Joe?
Yeah, and similar, it's just, for me, it's having that understanding what you're getting into before you write the check, right? Understanding the financial implications of owning and racing a horse, understand the tax implications. If you're expecting a tax benefit from it, understand that there's things that you got to do in order to get that benefit. And then again, just having the plan, being disciplined enough to stay on it. And then, kind of changing things up if things aren't working out.
Know when to pivot.
Right.
Yeah.
Okay, so that kind of wraps up our panel discussion. So we're going to take a little break here. We're going to move into our Q&A from the audience. And while I sort through the questions that are in the queue, we've got our West Point Thoroughbred, our sponsor for the Q&A. So let's go ahead and bring up West Point Thoroughbred's ad, and then I'll come right back with the questions from the audience. So let's go ahead and do that, and then we'll be right back.
How do you become the gold standard in racing partnerships? One horse, one partner, one victory at a time. Congratulations to all our partners who have made West Point the gold standard for the last 3 decades.
Okay, first question in the Q&A queue. So it's foaling season. Yes, that's a great time. So what about insuring foals and broodmares, Mike? So how does that work?
So we insure foals at 24 hours of birth. They have to have certain veterinary requirements. They have to be healthy. They have to have good plasma levels, but they are insurable at 24 hours of birth and greater. Broodmares are very standard coverage. It ratchets, the rates go up after the broodmare turns 15 years old with most companies, but very standard coverage. Broodmares are covered for mortality. Foals are covered for mortality. You do get into some gray areas with foals that might be on medication for various ailments. But we work with the people and we work with the companies. And so once that foal hits 24 hours, we get a vet cert and a plasma reading and we're off to the races.
Okay, great. So here's another question about mares selling in foal. So how about a mare that's sold in foal? Consignor shows a letter signed by a licensed vet indicating she's in foal, but found out after that she's not pregnant. Can the sale be canceled?
So you guys want to take a shot at this? You want me to do it?
You can start up. Yeah.
So when broodmares are entered into sale, they have to be palpated to be pregnant within a certain amount of days before the sale actually occurs. Usually it's before they leave the boarding farm, right? Occasionally we had horses ship in from other states that get palpated on the grounds, but in the repository of the sale company itself is a certificate that said the horse is pregnant. That is from a licensed veterinarian. If in fact, and it has happened, but if in fact somebody goes but buys a mare, they tell their vet to go palp it because they want to insure the fetus, unborn fetus, and the vet says this mare is not pregnant, then the sale will be canceled through the sale company.
And that's before the mare leaves the sales ground, I understand.
Absolutely.
Yeah. Okay.
And I'll be the lawyer and say it's not always black and white. It depends exactly what was certified, exactly how it was certified, whether the prospective purchaser engaged in a pre-purchase exam, a post-purchase exam, how it was discovered. That issue, to no surprise, has been litigated more than once, and I think you'll find that there were factual circumstances that varied the outcome in each of those. The most important thing with respect to buying and selling at an auction, and particularly with mares and dealing with reproductive status, is to do your due diligence, read the conditions of sale, make sure you're dealing with an agent and a consignor that you can trust, and that you're not just taking people's word for it. You got to do your own due diligence.
Okay, good point. Next question. After I buy a horse at public auction, the original handler takes it back to the barn and something bad happens. Whose fault is it, or whose responsibility is it at that point?
Well, the ownership rests with the person that had signed the acknowledgement of purchase. If there is gross negligence, that is, the handler takes and just drops the shank and doesn't try and turns the horse loose, well, then that will be on the employer of the handler. I believe Chapman will back me up.
Yeah, if the question is where is risk of loss, the risk of loss is going to be with the purchaser, because as of signing that ticket and taking out, you're bearing the risk of loss. Now, who may ultimately be liable for that loss? Again, it's a fact intensive. Did the handler deviate from a standard of care? Were there external factors at play? But I think the question is probably oriented towards risk of loss, and that would be with the purchaser once they've signed the ticket.
Okay. I have had a few over the years, particularly with mares that have had some age on them, where somebody will think they're getting a great deal and they're buying the mare. She might be a stakes producer and they're buying her for the stud fee. And I've had several at Keeneland where they walk back to the barn, they drop dead.
Goodness. Yeah, I wouldn't want to be the guy leading $1 million horse from the sales ring back to the barn. My golly. Okay. Next question. HISA has said that 5% ownership requires licensing, yet some tracks and states in the past have said 3% ownership requires licensing. What say you?
On the HISA piece, I don't know if it's licensing or it's requiring to be registered with HISA.
Okay.
HISA registration and ownership licensing are distinct. And that question, when HISA was rolled out a few years ago, that question came up time and time again, people kind of catching that inconsistency. But HISA has no jurisdiction or purview over ownership licensing whatsoever. That is still done solely at the state level on a state-by-state basis.
Okay, so
let me give you a small example of that. If you buy 5% of a yearling, and you have to be, it's called a covered person under HISA rules. You have to register on the HISA website. I own this piece of this animal, et cetera, et cetera. So there is a paper trail, or there's documentation to where if that horse ever becomes a subject of a HISA conflict, there is a way to understand who owned the horse, who was handling the horse, where the horse is, stabled, et cetera, et cetera. So I think it's called a covered person.
And to that question, though, again, from an ownership standpoint, especially if you're going to be in a co-ownership or a racing syndicate, keep in mind that by virtue of that HISA requirement, you are representing to that organization that these are the owners. If, on the other hand, you've only licensed one person, and in submitting that licensing application, you've made a representation that there's one owner, that's an inconsistency that, if uncovered, if it comes, if litigation happens or a regulatory violation happens and the racing jurisdiction catches a hold of it, they can raise a red flag with respect to your owner license being a misrepresentation. So you've got to be very, again, on the front end, having all your ducks in a row with how it's going to be structured, who's registered with HISA, who's licensed, and make sure you're making all accurate and necessary disclosures.
Okay. A couple more questions and then we'll wrap up here. So should I have a written contract with my trainer?
That's not for me.
personal preference, how much you trust the trainer. I'm an attorney. I am all for implementing contracts, having transparency, and setting forth expectations on both sides of it. I'm astutely aware, though, that written contracts with trainers are anything but the norm. Would it be a best practice if adopted uniformly? Absolutely. That is maybe the single most ingrained area in the industry where contracts are not widely used, if used at all.
Okay. So,
and I think one caveat on that too. I think there's probably a distinction between, general trainers and the situation where you have a private trainer. If you're entering into an exclusive relationship with one trainer where they're training all of your horses, or you see some trainers who only train for one or two owners on a much smaller scale, I think those situations absolutely would be ripe for entering into a contract.
Okay. Question just came in. If a managing partner insures a racehorse and sadly the horse is euthanized, do the partners share in the insurance payout?
Yes. Assuming that if it's an LLC, said horse LLC, the proceeds from the claim will go to the manager of the LLC, and then it is the responsibility of the manager to distribute the claim proceeds to all the co-owners,
Okay.
co-members of the LLC.
Okay. And last question just rolled in is for a group syndicate, do all the members need workman's comp? It used to be that way in New York. Do we have to have workman's comp as a group syndicate member?
So workman's comp, take New York. They take a per start fee to pay for a state-sponsored workman's comp plan that reduces rates. Workman's comp predominantly is the responsibility of the trainer and not the owner. Mm-hmm. The owners have had to share in the expense of workman's comp as it's gone up, but that is usually taken on a per start fee from the racing office.
Okay, well, that wraps up our Q&A and wraps up our webinar, guys. So thank you to all of our panelists for your time, your insight. Always learn something new when we do these webinars, and really do appreciate all that you have to say. So audience, if you have a follow-up question for any of our speakers today, please use the email address on the screen. You can contact them at any time. And if you don't want to write this down now, we'll have this recorded version of the webinar up in a day or two, and you can always fast forward to this portion. So thank you, Joe. Thank you, Chapman. Thank you, Mike. Really do appreciate your time and your expertise.
Thanks for having us.
Yeah.
Thank you.
But most of all, I really want to thank our owners, because without your investment in our industry and the racehorses, we just simply don't have a product. So we greatly appreciate that everyone took the time to be online with us today. If you're watching the recorded version of this, really appreciate you taking the time to do that. So next month, we've got a panel, takes place on April the 8th. We're going to talk about why owners are first. So we're going to have racetrack representatives here talking about, their owner relations and owner benefits at their racetrack. So until then, we just hope everybody stays safe and enjoy the lead up to the Kentucky Derby. So thanks, everyone. Appreciate your being here.